Australia's surprisingly low inflation result for the March quarter has many observers now wondering whether Australia has now officially joined the global disinflation, or in fact, perhaps what some might suggest, the global deflationary trend, and whether it will force the RBA's hand and lead to another cut in interest rates. So in this session, we'll just have a brief look at some of the drivers of recent inflation numbers and the implications for monetary policy. But first, just want to quickly review what is happening to global inflation rates since 2011. And I guess we draw our eye to the most recent observations, and essentially all the European countries have got either zero or slightly negative inflation, with Spain, Ireland, Greece all in negative territory, along with Italy, France. The UK has generated some slight positive inflation, and sticking above that, the black line is US inflation. This is headline inflation rates at around about 1%. And although Australia's number was very weak, it still is way in excess of global inflation rates, as you can see there. So the annual rate of inflation falling down to 1.3%, but still some way above global inflation rates at the present time. So let's just have a closer look at the release. So if we're looking at quarterly increases in the CPI, you can see that the negative result of negative 0.2 was the first time since 2008, 2009, and it doesn't happen very often, hence the scare around declining prices. If we look at what that change looks like over 4 quarters, we can see here that the annual rate of inflation has dipped to around about 1.7, so also at the bottom end of recent history. Now let's have a look at a trimmed mean measure, I guess a core measure, and you can see here too that has also fallen to really its lowest levels. You've got to go back to the late 1990s for it to reach similar levels. So as I mentioned, now we have the trim mean, or a measure of core inflation, below 2%. And we haven't, as I said, haven't seen that since the late 1990s. So where is this coming from? Well, if we break the CPI up into tradables and non-tradables, we'll first have a look at tradable inflation. As you can see here, this has been persistently below the core level of inflation. I suppose global competition and trade has meant that tradables goods inflation has generally been flat to down, although as you might expect, a lot more volatile. So it is in very low, below 1% at the present time. What about non-tradables? So when we talk about non-tradables, we're thinking more in the service sector, and looking at that, we see that our rate has been much more closely aligned with the overall level of inflation. In fact, service sector or non-tradables has been higher than the CPI over the period sort of 2010 through to 2015, but this recent decline back closer to the overall rate is perhaps somewhat concerning, and a level of inflation that we haven't seen really since, once again, the early 2000s, late 1990s. So tradables or service sector inflation is starting to fall away. So let's investigate the drivers of each of those components. So we're looking at tradable goods inflation. As I said, it's been broadly on a downward trend, although a very volatile series. As you might expect, movements in the currency have typically played a fairly significant role in changes to prices here. So if I get the percent change, let's just grab tradables again. Tradables inflation, and let's get the trade movements in the trade weighted index. Actually, I'll put those over on the right hand scale. What you'll see there, so the red line is the movement in the trade weighted index, and probably in the early 2000s right up until about 2011, broadly changes in the currency tended to be reflected in changes to tradable goods inflation. However, that relationship seems to have broken down since about 2012, where despite a declining currency, tradable goods inflation has actually been very weak, unlike in the past when you've had significant currency devaluation and tended to flow through to prices. So that's one important change that has taken place over the last 3 to 4 years, the breakdown between the currency and tradable goods inflation. What about non-tradables? So if we get non-tradables inflation, now you would expect that a key driver of that is going to be what's happening to wages growth. So let's have a look at that here. And as you can see, that's broadly right. So wages growth, the red line, has been heading down, sitting at around about 2%. That was back in December. Obviously expect it to be around about that number. But the tradable goods prices have dipped below 2% for the first time since, as I said earlier on, since the late 1990s. So this is quite a significant move in tradables prices. And as I said, it does reflect the decline in wages growth that we've seen. Now we want to have a look at the individual sectors or industries within the CPI. So if we run through these, and I'm going to base these at 100 at the end of 2011, we'll see some of the trends that have been flowing in these numbers. So this is clothing and footwear. So we've actually had deflation, as we all know, in that sector. Housing has been quite a strong rise over that time. That's up something like 80% over that 14, 15-year period. Household contents, fairly flat. That's the gold line. Health, we can see the green line. That's been significant. Up, it's basically doubled over the past 15 years. Transportation is the purple or blue line here. Now that's been quite flat, particularly over the last 3 to 4 years, and clearly fuel prices have had a more recent impact on that. Communications, that's the purple line, light purple line. That has been in decline since 2014. Recreation is now the green line. That's been fairly flat in comparison. Education, you'll find very similar to health, and that's basically more than doubled over that period. Finance and insurance, that is the darker red line. So that has been on a fairly steady increase, but albeit a fairly moderate increase over that period. And we'll finish up with food. Food is the blue line here. That's been pretty flat after rising consistently in the early 2000s. It's been very flat since about 2011, as we can see here. And then alcohol and tobacco, which is the recent blue line here, that's been quite a strong increase. So the sectors that have had strong price increases in what has been basically a disinflationary environment, and even more severe in recent times, have been healthcare, education, alcohol, tobacco, and housing have been the areas where price increases have actually flowed through. What about the implications for monetary policy? Does a decline in the core measure of inflation below 2% mean that there's a very high likelihood of RBA easing? Well, not necessarily, particularly just looking at this measure of inflation. The RBA's goal is always more of a medium-term goal, returning to the 2 to 3% target band. So if it's not confident that that will be the case, then yes, it does increase the likelihood of an RBA easing. If we just analyse this in the past, and I'm going to look at the cash rate, 3-month changes in the cash rate, and I'm looking at periods where the CPI, the trimmed mean, that's the core measure, is below 2%. So that's what it looks like here. Let's just show this, the two of the charts together. So that's the raw chart. The blue line is the cash rate. The CPI trim mean is the pink series. So if we're now looking at when that's below 2%, as it is at the present time, what has actually happened to the official cash rate, and we're looking at that. So when that's been true, and it's been true about 10% of the time, yes, on average, cash rates have declined. And they've declined over a 3-month period. We're looking at about 23% of the time. But they've also declined when the trimmed measure has been above 2% as well. So it doesn't have a high T-stat. So it doesn't look to be a particularly strong indicator. We tend to prefer to look at the implied inflation expectations. And if we look now at periods where that is below, say, 2%, let's have a look at the results here. And when it's been below 2%, cash rates on average have declined about 17 basis points, almost 30% of the time over a 3-month period. You can see a higher T-stat, but you still get these periods where, in fact, they're um, well, where they're cut, even though implied inflation expectations are below or above, 2%. But if I lift the threshold slightly higher, and we tend to use a threshold of around about 2.3%, so they're at the lower end of the band or through the band, then the T-stat improves quite measurably. The average decline in cash rates over a 3-month period, about 21 basis points. Almost 38% of the time we've seen declining rates over a 3-month period versus only 15% in all other cases, i.e. when implied inflation expectations are above 2.3. So our conclusion would be that if implied inflation expectations remain at these low levels, and in fact, if we look at the actual level of implied inflation expectations, currently sitting around about 1.5, 1.6, that indeed would be consistent, a fairly high chance of a rate cut over the months ahead.